Hey everyone, Ian King here, editor at Banyan Hill with your weekly market insights video. Remember, if you like our videos, please give us a like button. If you haven't subscribed yet, I don't know why you haven't subscribed yet, subscribe to our channel. And as always, feel free to leave us comments on the bottom. We'll be sure to get back to you. Joining me again this week is my friend and colleague, Jeff Yassin. Jeff, how are you doing this week?
I'm doing good, staying safe and trying to adhere to all the protocols while still trying to have something of a life. It's just like, as you know, you live your life inside your house and maybe the immediate confines of your neighborhood, and that's about it.
Yeah, it reminds me of that 76 film, I think it was called The Boy in the Bubble, that John Travolta starred in.
Yeah,
It's like we're all living in that film right now, right?
that's for sure.
So a couple things we want to talk about today. Last night, the administration held a press conference and they extended the kind of stay-at-home guidelines and the social distancing guidelines from mid-April to April 30th. I think that's positive for markets. Jeff, what's your take on that? And how do you think this is going to play out for investors?
Yeah, I take it in a positive way as well. And especially the President Trump said something about, thinking that, and I presume, you hope that he was saying it based on the advice from the epidemiological advisors for this sort of thing, but that they would see the number of cases peak in roughly 2 weeks. But whether it's 2 weeks or 3 weeks almost doesn't matter. Just the idea of knowing that and reminding people, as I think we both have already, that there is a window to these things as far as them getting exponentially worse, and then they actually get exponentially better. And I think that reminder alone is very, very helpful to the market. And we're also seeing stuff in the background. Abbott Labs has a new testing regimen for the coronavirus that was approved by the FDA on an emergency basis. We're seeing Johnson & Johnson. They're stepping up with a coronavirus vaccine that looks like that's being expedited. So there's just a lot of things out there. So everybody realizes, this is not, the zombie apocalypse. This is something that, even though we haven't seen it before, we're going to get through it. The market's going to get through it, and the time to be positioning yourself is now.
Yeah, I mean, I think that's a good take. And especially what you mentioned, this new test from Abbott Labs that can detect whether or not you're coronavirus positive in 5 minutes, and they can do it right on the spot. And I think that is going to be a huge way or method that we can kind of bring the economy back to full speed, because we can quickly identify people who are coronavirus positive. Right now, I mean, everyone is fearful of going anywhere because you don't know who may or may not have the disease. But if we can kind of ramp up detection and then identify where those people have traveled in the last week or so, we can show people where the hotspots are and maybe where they should be avoiding. So, I agree. I think that was a huge step by the administration. Keep things shut down, slow the spread, keep the curve a little bit flatter. And this is really what I feel the markets have been looking for since really the sell-off began, is really how we can mitigate the spread. Now, I want to shift a little bit because I want to talk about the bull and bear case going forward, because last week, between Tuesday and Thursday, we had a 21.3% rise in the Dow, and that was the best 3-day rally since the early 1930s. So we're looking at a market that just had a historic precedent last week. But it seems like we got to the point where it's like, okay, what now? What do we do? Can you help us just outline the bull case? I know you're bullish on the market right now, and maybe I'll talk more about the bear case after you kind of tell our viewers why you're bullish on the market going forward.
Sure. A couple of key points here. One, the Fed has stepped up with basically unlimited support, and we can debate whether that's good in the long term or not, but the fact is they're basically saying we're supporting this market 100% regardless, provide liquidity, do anything that's possible to keep it from becoming a gigantic crash. So that's key. We're starting to see everything else gear up in terms of, as we were saying, in terms of testing and new technologies and the vaccines and everything else that will be coming at some point down the line. And the other part is just, you were saying about the rebound we had, and likewise, let's just call it for what it is in some ways. It was a crash. What was the S&P's decline? 37%?
About 35%. 35%.
35%. And I think it's the shortest, a bear market that, from top to bottom, to put us into a bear market in the shortest length of time. I can't remember if it's ever in the 20th or in the 21st century here, but it was a record plunge. And when you see that, again, to me, that just says that investors were trying to discount everything possible. And now they're going to try to, pull it back. And I think both of us recognize that there are times, and we saw that with the market, where it really didn't matter what you owned, or if it was bonds, gold, or any kind of stock, even the safest of safe stocks, they were all going down at the same time. And that just shows pure out and out panic. There's just literally no place to hide. Mm-hmm. And at times like that, that's what you want to see, because even now to say, boy, I'm bullish, or I want to buy a stock, or I've been buying stocks, which I have, it's not easy. It's hard, but that is one of those instinctual things that, that, yeah, could we go down and retest the lows? Sure. We could have a couple of close looks at that, but I'm bullish. I think that things are going to be looking better, even if the news is still bad for coming weeks.
Mm-hmm. To your point, you bring up a really good issue, because there was no place to hide for a couple of days. And, as a hedge fund trader, we used to always have our hedges out there. So if we were long stocks, we'd be short bonds. If we were long bonds and short stocks, and also a combination of maybe long gold and short stocks at the same time, there were a couple of days where everything sold off simultaneously. And that's not something you normally see. The stocks were down 10%. Bonds had sold off. I think the rate on the 10-year went from about 50 basis points to 1.25%. Gold also pulled back 10 or 15% just in a couple of days. So we even saw the hedges getting hit, and that's very rare. And it's a sign really that a lot of these risk parity funds, a lot of these hedge funds, started to liquidate. They just had to get out of their positions because maybe they're over leveraged. The hedges stopped working all at once, and so they cut down exposure. And, I think that is really a sign that there is a bottom. But I want to shift to the bear case now, because we have to kind of outline also what the market could be doing, because we're at this point where the market says, what now? And I want to bring up this chart that we can discuss from Goldman Sachs this morning. And it basically is a chart of what happened between September 2008 and January 2009. And during these bear markets, there's one thing you have to pay attention to, is that they're a war of attrition. Bear markets don't get you out, they wear you down. They're bad for bulls, they're bad for bears. You get to a certain point where you just say, okay, this is uninvestable, this is untradeable. And even from a bearish side, if you look at what happened in 2008, you were looking at 6 increases of 10% or more, 9% or more. And a couple of them happened just in a few trading days. So even if you're bearish and you're short, you had to deal with these rip your face off type short squeeze rallies. And that's why these bear markets just are hard for everyone. And I could see a case made where, maybe the coronavirus lingers a lot longer and resumption of economic activity doesn't start till late summer. And so the market might not respond as well as we had thought, because of all this financial and fiscal stimulus that's coming right now. What are the things that you're going to look for, Jeff, to maybe say, okay, not that the bottom isn't in yet, but maybe the market isn't really ready to rally yet? Are there any keys that you could share with our viewers that you might be looking for to see if maybe this is going to go longer than we expected?
Well, let me put it this way. To me, the ideal scenario here is not a V-shaped bottom, or necessarily even, like a double bottom, but I call it like a muddle along bottom, where basically, let's say the market, even though we'll continue to get these days of extreme volatility up and down, if we just sort of muddle along here at somewhere in these levels, all right, we get used to the degree of volatility because it's basically moving inside of a wide range, but at a lower level, right? And this is something we saw in 1987 after the 87 crash. The market moved sideways within a wide range, literally for months. And, people, it kind of put people to sleep. There were a great many people at the time saying, there's a next leg down, there's a next leg down. And you know what? There never was. And you can't even point to a distinct bottom except right there on the days when the headlines were out about the market crash. And after that, it just sort of bounced along and then slowly built strength. That's what I want to see. Either that or we see some sort of panic low that we put in sometime in the next week or two. And ideally, maybe we get down to that 2050 level, which on my charts happens to correspond to some trend lines that I have drawn in. But I also know that Goldman Sachs and others say that's where they see a bottom at. But it doesn't mean it has to happen that way. But let's just get it over with. So if you see that kind of thing, I would be buying into that as well, because again, I think we can see that the beginning of the end of the coronavirus is ahead of us here. Massive amounts of stimulus. The Fed is there. And the other thing is just don't buy expecting that the stock you just bought is going to be up 5% at the end of the week and 20% in a month. It's not going to work like that in an ideal scenario. It's going to be just sort of mushy for a while. And that's healthy because that means it keeps a lot of people on the sidelines and keeps things from getting too bullish too quickly and allows the economy to sort of gear up. Because make no mistake about it, there is a lot of difficulties here in terms of people missing their credit card payments, mortgage payments, sending the rent if you're a retailer, sending the rent to your landlord. There's a lot of that still has to filter through the economy.
Mm-hmm. I agree with that take. And, when you say kind of muddle through, if we see like a period of less volatility and the market feels like it's flat, something people don't understand is that there's a battle going on every day. And the battle is between short-term holders and long-term holders. And when you have flatness like that, you have this kind of accumulation phase where people who have a short-term focus decide that they're giving up on stocks, they want to get out of them, and they sell their stock to somebody who's a more longer-term holder. And this creates a base in the market and allows the market to rally in the future because eventually those short-term holders, we know, they come back, but they buy in at higher prices. I think that's a really good take, Jeff. And, one last thing that I want to just highlight, we've been talking a lot about sentiment in the market, and I want to just pull up this chart of the CNN Fear and Greed Index right now is up to a fear reading of 29. Last week, it was at extreme fear. So we're starting to see sentiment come off the lows a little bit. What is your take on that? Do you think that we're going to get to a more neutral place as the market rallies? I doubt we're ever going to get to greed again. But does this play into anything in the way that you look at the market?
Yes, because I think if we have sentiment that remains fearful, again, if you will summon the courage to buy good stocks at these prices, you will be rewarded for it. But again, the difficult part is knowing that you're not going to get that immediate positive reinforcement of a higher stock price necessarily, within the time frame that we've all sort of been, trained a day, a week, a month to say, yeah, this is a good stock because it's going up. A lot of the best stocks will probably just move sideways for a while. So when I see sentiment sort of dampen down, and as the market rebounds, there's tons of people and a lot of smart people on Wall Street who are saying, I wouldn't buy this. It seems like it's just it's just a bear market, dead cat bounce, that sort of thing. I take that as a positive. It doesn't mean you're going to be right? But it doesn't mean you'll bet the farm. But this is the chance, when we say about going shopping for stocks, this is a chance to go out and do that. And you can buy, let's say, a Procter & Gamble or any of these other companies. They're going to be here now, a year from now, and 50 years from now. This is a chance to go out and buy those and get really good dividend yields on them at a time when you're not going to make interest on anything, whether it's a CD or checking account or frankly even a bond these days.
Yeah. Yeah, that's a great piece of advice. Obviously, the old axiom comes in now: buy when there's blood on the streets and
Yeah.
sell to the sound of trumpets. But I think that's a good place to leave it this week. Jeff, I want to thank you once again for joining me this week on our Market Insights call. Thank you, viewers out there. I hope that you and your family are staying safe, practicing your social distancing, and making sure that you have enough food and things at home to get through this next month. I think we're going to emerge stronger for this. It's going to be a rough ride, but there's always a light at the end of the tunnel. Thanks again for joining us, and we'll see you next week. Take care.